All right, what's up, traders? What's up, tycoons? Coming at you guys with another update on TLT. And man, it was another bearish day in the market. We saw TLT down by a lot today. So I'm going to go over some important data for you guys that I think is pretty relevant that you should be aware of before we jump straight into the technical analysis. So if you're here just for the TA, all you've got to do is skip forward to the second half of the video. But with that being said, we'll jump straight into it. And so we have someone now known as the 50-cent trader, okay, the 50-cent VIX trader. What happened was someone paid 50 cents for 100,000 call contracts worth $5 million, betting that the VIX would surge to 50 in May. And then they went ahead and they bought another 50,000 contracts at 51 cents, upping it to about $2.6 million in total. So combine that together, that's going to be $7.6 million bet that the market was going to see increased volatility and that the VIX index would go up. Now, they bought these last week and definitely has paid off. Now, the big question is, why would they be making such a large bet? Okay, and so some of the answers to those is we have the Fed minutes coming out here on Tuesday. A lot of times you see the market tend to go risk off in those time periods. All right, and so when the market is risk on, you're going to see the VIX start to decline and go lower. All right, and that's been the case, in January when we had a really bullish market. The VIX was heading down lower while the S&P and the stock market was going up higher. So, that's just some of the reasoning behind it. Not only do we have the Fed minutes coming out Tuesday, those Fed minutes are really going to help dictate and interpret, or rather dictate how the market interprets the PCE inflation reading coming out on Friday. Okay, now the PCE is one of the Fed's favorite instruments for really measuring inflation. And so, you're going to be able to go through the Fed minutes and really see their verbiage and their language and how they could potentially react to the PCE data if the PCE data comes in hot or if it comes in cold, just depending off of that. Now, something pretty important that I haven't been highlighting in too many of my videos because everybody is talking about it, but I need to talk about it as well, guys. It's the yield curve inversions. The 10-year, 2-year Treasury yield is the lowest inversion that we've seen since the 80s, okay? It's lower than the 90s and the 2000s. And the reason that this is so important is because it's after it uninverts that you see the recession. So, just because it's inverting doesn't mean that the pain is over or that that's max pain right there. The recession actually comes afterwards once it's uninverted, right? That's when we see these recessionary periods. These gray boxes right here are all recessionary periods. If you take a look at the 10-year 3-month Treasury yield, okay, this one is the lowest it's ever been. It's the lowest it's ever been. And again, same thing, it's after these things, uninvert that you end up seeing these recessionary periods in the market and in the economy. All right. Now, if you take a look here, this is PCE we have here on the left, and then core PCE right here on the right. Core is something that the Fed really focuses on a lot. I've been covering a lot of the core sticky inflation. We'll get into that in a second. But if you take a look here, you can see that the forecast for the next one is going to be 4.8% on the PCE annual change. So remember that number. Okay, and if we come in hot, we come in cold, it's going to be based off of that 4.8%, that number there, basically. Okay, so we'll have to see what we end up getting. Now, when it comes to the core PCE has been coming pretty much hotter than the forecast for the past few months, right? So over here, or I mean, it's actually been basically right up online. Okay, we had 5%, 5%, 4.7, 4.7, 4.4, 4.4, and now they're forecasting 4.3. So it's been gradually declining, as you can see, from December, okay, up through January. Now we're going to get this newest report for January and February. And so, they've done a pretty decent job of forecasting it. And we could come back to those similar forecasts. And if we do, that could be a little bit of, something for the bulls to bite on, right? And really try to get the market rallying back up again. We had such an amazing January that February has been a little bit sideways and starting to pull back now, but we haven't seen any dramatic U-turns when it comes to the overall market shift. Now, TLT, on the other hand, is a much different story, and TLT has been dropping a lot. And the reason being is because treasury yields are still continuing to rise. And I've told you guys, as you see these treasury yields rise, the prices of bonds are going to go lower. That's just how bonds work. If you take a look at this next chart here, this is the stock market versus financial conditions. Now, these are the Chicago Fed national conditions as well as the adjusted national financial conditions index here in red and white. And then we have the stock market itself in this yellowish color. And we can see when Jerome Powell did his famous Jackson Hole speech and really just, put a knife in that in that bear market rally that we had when the S&P was rallying very, very much. You can see that financial conditions actually went up, right? And they actually started to tighten. But we've increased the Fed fund rate has increased 300 basis points since that time, and financial conditions are actually weaker. Okay, they're actually weaker than when we initially first started hiking rates back over here in this time period. Now, what's really interesting to me is that Jerome Powell said the exact opposite. Okay, in his last speech, he actually said financial conditions have been tightening. Now, the only financial condition index that shows financial conditions been tightening is going to be the Goldman Sachs Financial Conditions Index. So that's some very, very interesting data, in my opinion, is that they're using Goldman Sachs, which, I mean, they're a publicly traded stock. So, are they manipulating the numbers a little bit? Or does the Chicago Fed just really have the numbers that off, and they're showing financial conditions easing and loosening rather than tightening, like the Goldman Sachs Financial Conditions Index, which I don't have Bloomberg Terminal. Okay, so I don't really have access to the Goldman Sachs Financial Conditions Index. I make all of my charts pretty much off of TradingView. This is the core sticky versus the Fed funds rate. Now, I've been highlighting this. If you take a look, all right, by the time you actually see core sticky start to go down, which is going to be the white line here, all right, it's once the Fed fund rate, the red line, is up above it. Okay, so once the Fed fund rate goes up above, then you see core sticky start to go down. Okay, and then over here, you see it start to go down. Fed fund rate up above, you start to see core sticky start to go down. We're not there right now, guys. We're definitely not there by any means. And core basically inflation is going to be a lot stickier than people think and a lot stickier than people are pricing in. Now, if you take a look, it has come down slightly. Okay, so look, big drop, right? I mean, barely anything. Okay, it's barely moved to the downside. Last time it did this, it went right back up. So, will that happen again? And will this thing go right back up, core sticky inflation? Or potentially could it trying to be starting a downtrend, right? We have to keep all possibilities open. And who knows, maybe this thing will start reversing, but we're definitely in no way, shape, or form seeing core sticky inflation in a deflationary period or a disinflationary period. And it's really not going down at all. Even though it's ticked down a little bit and it's put in a new peak, it's still higher than what it was in the summer of 2022. Now, this is the Jeffries report. Okay, they put out a report here basically saying the world of sticky tightening and invested easing. Now, neither the labor market nor inflation is necessarily behaving as the equity markets would wish. Both are not cooling fast enough. The deep curve inversion, which I just showed you guys, the yield curve inversions, is not good. Okay, that's not a good sign. This cycle is increasingly resembling the 2000 to 2002 tech bubble. Now, January CPI was in line with expectations. It slowed down enough to be termed disinflationary, but it is unlikely to deter the Fed from hiking rates in March and potentially in May. And the reason being is that the CPI reports from last Friday, okay, they paint a picture of inflation that's very sticky at the core. Now, it's just crazy because I've been showing you guys core sticky inflation. I've been highlighting this, and this has been one of the things that a lot of people haven't really been talking about, and they're only talking about CPI. But this core sticky inflation is really important, and it's definitely something that the Fed is paying a lot of attention to as well. Now, here we have some TA. Okay, we have the TLT daily chart. So you can see another red candle. All right, we've been trending downwards. When it comes to really trying to trade the market and trade different things like TLT or the stock market or the bond market, whatever it is you need to combine a couple of indicators together, right? And that's what's really going to help give you an edge So what I mean by that is what I like to use in my videos is we have the MACD here. We had an entry signal over here when the red line crosses up above, all right? And you can see TLT ended up going up much higher. Then we got an exit signal when this red line crossed below the blue line on the MACD, and we had a move to the downside. Over here, entry signal moved to the upside. And over here, we were questioning what was going to happen, right? We had this very, very long consolidation period that was pretty unusual, right? This was basically the longest TLT has traded sideways in a very long time. And we were a little confused on our structure, right? We've been tracking this large orange 5-wave structure to the downside, taking TLT to anywhere about $80 to $90 per share. And the way it works is, your wave 3, the C wave, and your wave 5, those are 5-wave impulsive moves. And then your wave 4, the D wave right here, is going to be an ABC correction, right? So we got our ABC correction, we got our wave 1 down, right? And we took some profits right along here along this trend line. And we came up, we got the bounce, we were expecting this type of move. And rather than just coming straight down for our next wave 3 structure, we consolidated and traded sideways for a very long extended period of time. But here recently, we've seen treasury yields such as the TNX start to rally and start to go up. And as a result, you're going to see bond prices start to go down, which is why TLT has been going down. On top of the technical indicator right here on the MACD, we also had some bearish divergence on our relative strength index trading in this bearish channel right here. Okay, so notice how essentially TLT was going up at this time period. All right, TLT was going up, making higher highs and also higher lows. But meanwhile, the relative strength index was losing relative strength, making lower highs as well as lower lows. And that's a bearish divergence. You combine that with this little bit of a rising wedge right here, and we did get our sharp pullback to the downside. And I mentioned that we could end up coming and filling this gap right here, this blue line right around $100. And we definitely filled that today. We closed beneath that gap. So, no half gap fill, no chance of really a strong bullish indication here. Now, I wouldn't be surprised if we get any type of rally and any type of bounce here soon. All right, that wouldn't really surprise me, but if you take a look, we've been trending downwards ever since we got that MACD sell signal, really combined with the bearish divergence and the breakthrough of that channel to the downside. Now, another possible scenario that we could be getting here is an M pattern based off the double top right here, as well as right here. We have this nice M pattern, and that could take us to the gap down below right around $95. So if that happens, we do have this trend line here of support where we could potentially end up finding some support, guys. All right. So if we continue to head lower, there definitely is the possibility to fill this gap down here to 95 if we don't get a bounce sometime soon. But below 102.88, we're really going to be bearish. All right. And the reason being is that these are the 3 major Fibonacci retracement levels right here, the 61.8, the 50%, and the 38.2. The reason you use these is because nothing moves in a straight line up or a straight line down. Rather, you get a move down retracement and then a continuation of the trend, or you get a move down retracement consolidation and then a reversal. So if you take a look, right, previously we had a big move to the downside, all right, and that was our wave 3 to the downside. We got our ABC recovery, and look at where we rejected, right? We rejected right here exactly at our 61.8% retracement level, and then we came back over here again and retested that level and pushed back down again, forming a double top. So if we take in context with how the 3 major retracement levels work, we've moved down, we've retraced, and we're consolidating right now for sure. If we're able to break out past 109.70, 109.69, that area right there, then there's a very strong possibility we could be getting that reversal and attempting to put in a new high. But for now, we've been rejecting it, okay? And there's the more likely scenario is that we're continuing the trend downwards as we're rejecting the retracement levels of the downtrend. And all of this move up here was nothing more than a healthy retracement, which we already had built into, the structure with the ABC correction wave before our next big leg down. So we'll have to see how things form and how things can continue to develop. I definitely try to keep an open mind, right? Like we did have this bull flag structure here just in case we were going to break out of this level, but instead, rather we broke down. We got a breakdown on the bearish channel. We got a MACD sell signal, and TLT has been dropping as of lately here accordingly. So, the signals are working and they are still playing out. It's just going to be a matter of, really just determining how things continue to move and if we can continue to, understand some of the market structure and some of the price action in the market. Now we have quad witching coming up. That's going to be on March 17th. If you're not familiar with that, that's basically when 4 different type of contracts expire. You have like option contracts, you have future contracts, all these different type of contracts basically that are going to be expiring, and these 4 days are the most volatile days, not the most volatile day, but some of the most volatile days that you'll experience in the market. And the reason being is that it's got a large amount to do with institutions, right? So a lot of these contracts are going to be expiring, and institutions are going to have to figure out whether they want to execute some of these contracts that are expiring in the money. And if they have some contracts expiring out of the money, they're going to have to figure out what they want to do and whether they want to reposition as bearish or bullish. And that's just something to keep in mind, right? We love quad witching day in the Discord, as volatility is very good for traders, right? Volatility is what you need for a trading environment. If things are just flat and not really moving very much, then that doesn't necessarily present the best trading opportunities. Now we also have the target rate probabilities right here, and this is for the upcoming March meeting as well. All right, and so right now they're basically pricing in another 25 basis point rate hike at about 80%, almost just below at 79%. Now what's really interesting, okay, is if we take a look, and just 1 week ago they were at a 90% probability that we were only going to get that 25 basis point rate hike. So since then the market has basically priced in 10% less, and has actually increased the odds of a 50 basis point rate hike up to 21% from 9%, right? And 1 month ago in January, this was a 0% chance. So, things do change really quickly in a quick matter of time. And, we went from 0% chance of a 50 basis point rate hike all the way up to a 21 basis point or 21% chance. Now over here, we can see some more of the bets that people are making on the rate hikes. We can see that essentially they are now pricing in 75 basis points, all right, by the June meeting, all right? And the reason being that that's important is, again, if you take a look, 1 month ago, they were at 3%. So, there was a 3% chance that they were actually going to increase, the Fed fund rate this much. But after the recent round of inflation data coming out, they've priced that into now the most probable outcome out of all of the other scenarios, out of a 25, out of 50, or out of 75 basis points, or I'm sorry, out of 50, 75, and 100. They now see us being 75 basis points higher by the June meeting as the most probable outcome. Again, a very, very big change from January 20th, from 1 month ago. Now, if you take a look over here, all right, what we have is pretty interesting. This is for the December meeting. And if you take a look, they're at 500 to 525 basis points. Now look here, it's at 525 to 550. So they're actually betting that, by December, okay, over here at this 500 to 525, that the Fed is actually going to start cutting rates. They're betting that they're either going to cut rates or that they're not going to raise them all the way up to the 525 to 550, which is priced in for the summer. So there's a higher likelihood via the target rate probabilities that we're going to be at 525 to 550 in the summer, but by December they're thinking that we're going to be at 500 to 525. So really, really interesting to see how things turn out, and to see where the bets are, right? And essentially they're saying that still, hey, we think that the Fed is either going to pause sometime soon, or that basically he's going to start cutting towards the end of the year in December of 2023. Now the next chart we have right here is the TLT all-time highs and the all-time lows. And the reason I'm showing this to you guys is to really give you some perspective. All right, I have a couple trades on the next slide that we're going to go into, but if you take a look, the high here, all right, was 179.7, basically 180, and the low here was 80.51, basically 80. Now TLT spreads really could be the trade of 2023. Keep in mind what we talked about as yields go up, as rates go up, you're going to see bond prices go down. The Fed fund rate won't stay elevated forever. It may be higher for longer. Okay, but eventually at some point they are going to pause and potentially even start cutting rates. Now, nobody knows exactly when that is. So I'm not telling any of you guys to enter into this trades right now. I have no positions in any of these trades, but I just wanted to give you guys some perspective on some different trade possibilities that there are out there. Okay. Now, if you take a look, we have some vertical spreads here. And some of them are going to be credit spreads, and some of them are going to be debit spreads. So obviously, the debit spreads have the higher profit potential, right? And so what this debit spread right here is for the January 2025 expiration for TLT to be at 125 to 130. All right, so basically meaning if TLT is above 130, that this would be a 300% play. Now let's put that into some perspective, right? We're currently basically at $100 on TLT. All right, 130 is not really near the all-time highs. All right, it's definitely not near all-time highs by any measure. So it's not completely unrealistic, but it definitely is an aggressive play, right? You basically are betting that TLT is going to go up 30% in 2 years from now. So it definitely is an aggressive bet and an aggressive play and definitely risky. But when you look at the amount of dollars that you're risking $100 to earn a max profit of $400. So, when you think of it that way, it's got a really good risk to reward ratio where you're risking 100 for $400. And you don't have to open 100 of these contracts. You don't have to open 1,000 of these contracts. You can open up whatever's, tolerable for you. And then you can set yourself a stop loss along the way, right? Like if you put 50% stop loss on the play, you'd get stopped out at a loss of $50, but you risk that $50 for a max potential profit of $400. So, when it comes to the risk to reward ratio, they got some pretty decent setups, right? So this is another one here. This is a little bit less aggressive. This is the 115/120 call debit spread. And that offers about a 65% return if TLT is above 120 by January of 2025. Now over here, we have some smaller percentage returns, but when you think about it, these plays are they're almost close to being free money. Okay. Now remember, again, not financial advice, really just trying to, show you guys some of the different plays that there are out there. Now you can adjust strikes, you can adjust, expiration dates and things like that according to your own risk profile. But if you take a look here, we have the 80/75 put vertical credit spread. So remember, the all-time lows on TLT is $80.51. And look at how much TLT has declined already. So essentially, if you're taking this trade right here, you're saying that, hey, I don't think TLT is going to go below all-time lows at the time of January 2025. If it does, then you would lose on this play. But otherwise, you can get an easy 8.4% by selling this credit spread right here. You would need about $500 in premium, and you would get $42 in credit for each one of these contracts you sold. Now, it's nothing amazing, but when you think about it, okay, and you're taking a look here, these are the lows in 2003. So essentially, it's like saying, hey, I don't think TLT is going to go below its all-time low in 2003 in the next 2 years. So if you're even slightly bullish on TLT over the next 2 years, then potentially that could be a good play for you, right? So we've gone over some call debit spreads right here, a little bit of aggressive ones, some less aggressive ones. We have some less aggressive vertical credit spreads right here as well. Some put credit spreads. And we can take a look at another one. This is the 90/85 put. And basically you're just saying that, hey, I don't think TLT is going to drop. It is going to be $10 lower 2 years from now. Okay. And remember, a lot of the bond prices have to do with the Fed fund rate and with the treasury yields. And as those rates are going higher, the prices of bonds are going to go lower. So if you do think that the Fed is going to start cutting rates eventually, then these are some, bullish plays that you could enter in on TLT. You don't have to enter into any of them right now. Definitely be patient. Definitely go over the different risks with the different strategies, which one really fits your style best. And that's what I'm doing right now. Okay, I'm not really rushing into anything. I'd like to personally see TLT get 90 or below. If it does do that, then maybe I'll look at accumulating some long-term bullish positions. But for now, I'm really just tracking the patterns, tracking the movements, and seeing really where we're going to go and where we're going to go next, really from here. As there's a lot of uncertainty in the market, especially when it comes to inflation, sticky inflation. The Fed fund rate could remain elevated for years. Okay, it could remain elevated for the next 2, 3, 4, 5 years if we really lose a grip on inflation and inflation just stays sticky for a very, very long time. Then that's definitely a scenario. So I'm going to wrap the video up here, end it there. Appreciate you guys watching. Don't forget to smash the like button, subscribe to the channel if you guys are new, and I'm out.